Hello, everyone. I want to welcome you once again to my channel, Lessons from My Life, and I hope it's been an exciting journey with you. It's been exciting for me to just, come in every week and, say one or two things about real estate and also my experiences, doing real estate. So today we are going to be talking about variable or fixed mortgage rates. It's variable or fixed mortgage rates, some of the pros and cons. At the end of the day, making a decision depends on your risk, depends on your risk appetite, depends on what your assumption of the market is going to look like, right? I'm just gonna kick it off with talking about what is the definition of a variable mortgage rate and what's the definition of fixed mortgage rate. Now, a variable mortgage rate is defined as a mortgage rate that flows with the market. So if the market is moving, the mortgage rate is also moving. If the market is going up, the mortgage rate is going up. If it's coming down, it is coming down. That is called a variable mortgage rate. Now, the advantages of a variable mortgage rate is that if you go into a mortgage, if you close a deal and the rate is pretty high and the expectation is that the mortgage rates will come down. So if the mortgage rates come down, it means that you're actually benefiting. Your monthly payment is not going to change. However, the allocation of the payment between interest and principal is going to change, which means you're paying less interest and paying more principal when the interest rates are coming down. So a lot of people who assume that the rates are probably going to come down or maybe going to remain the same in a situation where the variable mortgage rate is lower than the fixed mortgage rate, then they go into variable mortgage rate because their risk appetite is that it should flow with the market. And then what are fixed mortgage rates? Fixed mortgage rates means that exactly as the word says, it is fixed. It doesn't move. It is fixed and it doesn't move. No matter how the market swings, it is fixed and it doesn't move. And I'm going to give you an example before I talk about the advantage of this. So when I fixed my mortgage, bought my house just right in the middle of COVID, what happened was that the mortgage rates were actually the lowest it had been in decades. So I was able to fix my mortgage at about 1.6%. And it remained fixed like that even when interest rates were going high. So 1.6% became my mortgage rate. So it's going to be like that for 5 years, right? And then when it comes to renewal, you have to deal with what the new market rate is and decide whether you want to fix or leave it fluid as variable. So the advantage of this is that when you think that the rates are going to go up in the market, the best thing is to fix it so that you take advantage of low rates while other people who are closing further down the line will be paying higher rates, which means you're paying a lot of principal, less interest in your monthly payment. Okay, that is it for variable and fixed mortgage rates. Now, when you want to think about it, which one is the best to go into? There are no best solutions, right? Like I said earlier, it depends on your risk appetite. Where do you see the market going? I'm also going to give you an example. Where do you see the market going? And that helps you to make a decision where you want to fix your rate. Do you want to do variable or do you want to do fixed mortgage rates? I'm going to give you an example, but before I say this example, just remember that I'm not advising you in the position of an expert. So if you want to close your mortgage and you're trying to make a decision, consult your mortgage advisor to make that decision. Okay, so I'm going to give you an example. So recently, I wanted to close on a property, and my mortgage broker was trying to get a mortgage for me using the variable interest rate. And the variable interest rates at the moment are actually priced higher than fixed interest rates. So I believe they were about 7%, and the fixed interest rate is about 6.9. I mean, the difference is not significant, but it still counts for something, right? So it's about a fixed about 6.9, and the variable interest rates are about 7.05 or thereabouts. It's like 0.25 difference between the two. Now, I thought about it. I'm like, we all know the expectation here in Canada is that the Bank of Canada has hammered the economy with a lot of hikes in interest rates. And the expectation is that at some point next year, we'll want to see the interest rates coming down. However, my assumption is that the interest rates are not going to come down beyond 0.25 because it's going to be very experimental for the Bank of Canada to make a decision on whether they need to be going down or leave it where it is at the moment, because they actually just released the inflation reports. Believe it was sometime this week, and the inflation for last month was 3.1%, and the Bank of Canada's target has always been 2% to 3%, right? So it is still a little bit higher than where the Bank of Canada wants to see it, but the trend has always been in a positive way, right? It is coming down from where it had been in the prior month. So the Bank of Canada is now poised. When you read some of the statements, they are thinking more about, do we leave it where it is or do we bring it down? So my assumption based on my risk appetite was, let's fix it right now, because I know it's going to be for 5 years. Maybe it's going to be experimental, right? It's going to be experimental. And then they drop it down by 0.25, and then the market goes haywire and people are buying more. Inflation goes up and then they have to bring it back up again. So I'm like, I'd rather just fix it now, because whether I do variable or fixed, if it's 0.25 reduction, is going to be about the same thing. So I made a decision. I said, what, let's do fix it where it is instead of going variable on the mortgage. So I know some other people have different views. Maybe it's going to come down twice in 2024. Therefore, let's keep it variable so that we take advantage of the 1%. So people like, this is 5 years. It's going to be a long time. Over that long period, it might actually be much more lower than that. And the thing is that once you fix your either variable or fixed rate mortgage, once you make the decision on which direction you want to go, over that period, over the next 5 years, it becomes difficult for you to break, because once you break, there's going to be a penalty attached to it, and the penalties are quite expensive. So sometimes when people consider those penalties, they don't even want to break their interest, because then you're not really saving a lot of money. So when you want to make a decision, consider some of these factors. Think about some of your risk appetite. Think about where you see the direction or the trajectory of the economy going, and make a decision based on your risk appetite. Remember again, consult your mortgage advisor before you make some of those decisions. Consider also your personal finance, decisions, just to make sure that you're not having a lot of, cash outflow there when you need to be saving more, or you don't have a lot of payments allocated to interest when you need to be having it the other way around. A lot of payment going to principal rather than interest. Okay, and that's it for this week's episode. We'll have an amazing episode coming up for you again next week. So if you haven't subscribed yet to the channel, make sure that you are clicking the subscribe button, and you're subscribing, clicking on notifications, so that you are getting notified when a new video is being posted. That is it for now. Have an amazing week, and I look forward to seeing you again next week.